please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Well, back home on the Lal Street, the markets ended at the low point of the day with the Nifty giving up the 11,000 mark. The Sensex as well ended with a cut of over 200 points, and the mid-cap underperformance continued yet again in yesterday's trading session with a cut of around 2.5%. The Nifty Bank as well ended around 1% lower. But how was trade set up today? And keep an eye out on crude oil prices as well. That's really come down to around $71 per barrel mark. Anisha joins us early this morning. Hi Anisha, good morning.
Good morning, Nigel. Well, yes, as you mentioned, Nifty yesterday went below the 11,000 mark. Sensex as well lost around 200 points. But what was really battered and bruised was the mid-cap space, because there was a real carnage there with the index plummeting around 2.5% in trade. The advanced decline ratio was also weak at around 2:11. And even if you look at the India VIX, that one accelerated by around 5%. And in fact, the important point to note there is yesterday we did not have any external reasons for this fall in the mid-cap space. There were no trade tensions, there was no crude move at least yesterday, there was no untoward move as far as rupee or bond is concerned, and no specific earnings disappointment as well. So that is something important to note, and no surprise in the cash volumes as well, because there's a net sell when you look at the institutional flows. So the FIIs yesterday sold around 626 crores in the cash markets, while the DIIs as well sold around 70 crores. Now if you're talking about the cues for today, as you mentioned, the most important cue for the markets today is what we saw in the crude yesterday when it slumped around 4%. Well, of course, there were statements that came out of the US Treasury Secretary and the department saying that they might look at easing the sanctions on Iran, and that's the reason we saw that slump in crude. Also, the supply concerns are also a bit abating given the fact that the Libyan ports have reopened. So that is one important thing to watch out for. And other than that, if you look at the US equities, the three indices actually closed mixed yesterday. The financials did well, and that's the reason Dow ended in the green given the fact that Bank of America came in with better than expected earnings. But the Nasdaq was lower, as well as S&P. Amazon also gave up most of its gain given the fact that there were some glitches when it comes to its prime day. In fact, the worries for the tech sector has not really ended, because post the market close, Netflix reported numbers and the subscriber growth was less than expected, and that's the reason Netflix plummeted 13% after the close yesterday. So something to watch out for today as well. Asia this morning is a bit mixed. The early raise from Hang Seng suggested a downtick, while Nikkei, which was closed yesterday, opened with a gain this morning. The Straits as well as Taiwanese index, as I last checked, were trading in the red. The SGX Nifty also suggesting a flattish start. But remember, the most important cues for the Indian markets remains to be earnings.
Okay, all right, Anisha. And stocks?
Well, yes, as I was mentioning, the most important cues continues to be earnings, and HUL came out with numbers. There's nothing to complain in the numbers. The domestic volume growth at 12% is at the higher end of the expected range. Other than that, a lot of results expected today. So Zee Entertainment, Ashok Leyland, Federal Bank, CRISIL, 8K Miles to name a few are expected to come out with numbers. We were talking about crude, and hence we are expecting some sort of reaction to come by in the OMCs, paint companies, airline companies, and the usual stocks that get impacted. IDBI Bank was very volatile in trade yesterday. Today as well, there is a bank board meet of IDBI Bank, which is going to consider and approve the LIC stake sale. To keep an eye out on that. Ashok Leyland was down about 5% after CNBC TV18 reported that there might be some changes to the norms of load carrying capacity. So in focus would be Eicher Motors and Tata Motors as well. Remember, Ashok Leyland, Mr. Dasari told us yesterday that this rule might cause some confusion. It might cause them extra cost to tweak the vehicles as well, though they believe there is no impact on volume. So let's see how it pans out for them today as well. Some distilleries will be in focus today because they're issuing some warrants to the promoter group. Adani Ports have formed the tie-up for rail logistics, so that will be in focus as well. Sunflag, a positive news because CRISIL has upgraded their long-term rating now, and Bharat Electronics and BEML have signed some MOUs in the defense space, so they will be in focus as well. Back to you.
Well, let's talk about the macros then. The International Monetary Fund, or the IMF, has released its latest update on the world economic outlook. It expects India to grow at 7.3% in FY19, which is a tad bit lower than the IMF's April forecast of 7.4%. Ritu Singh is here with the details. Ritu?
The IMF has not exactly painted a rosy picture for the global growth or for the Indian economy itself. In fact, in its World Economic Outlook update, IMF says that it has cut India's growth forecast for the current financial year by 10 basis points and sees India growing by 7.3% in FY19 compared to 6.7% in the previous fiscal. It also sees that growth rate rising by a mere 20 basis points to 7.5% by FY20, which is almost 30 basis points lower than what it had projected in its earlier forecast. It says that lower growth reflects negative effects of higher oil prices on the domestic demand for India and the faster than expected monetary policy tightening because of the sharp rise in inflation that we've seen in the past few months. But globally, it has maintained the global growth forecast at 3.9% for 2018 and 19. This compares with, it's just a 10 basis point growth compared to 2017, which was at 3.8%. For advanced economies, growth is projected to increase by 10 basis points from the previous forecast to 2.4% in 2018 and 2.2%, which is a slowdown, by 2019. For emerging market economies, which have been hit by rising oil prices, higher yields in the US dollar appreciation, trade tensions and geopolitical conflicts, emerging markets are seen growing at about 4.9% growth for 2018 and 5.1% for the next year, that is 2019. The risks to global growth, according to IMF at this point, is, the biggest risk is the trade tensions escalating between US and its various trading partners and the repercussion that will have on the growing economy. And therefore, IMF says that going forward, the countries must remember that avoiding protectionist measures do remain essential to preserving global expansion.
Well, moving on then, the government is all set to introduce new rules for load capacity of trucks and tractor trailers from today. We learned from sources that the government will hike the load carrying capacity by up to 25% for these vehicles. The government is also citing improvement in road quality as one of the reasons for this move. Parikshit Luthra joins us with more details on that. Parikshit.
The government is all set to notify new loading capacity norms from Tuesday. We are told that this is happening for the first time since 1985 after a span of 35 years, and this could increase loading capacity for heavy commercial vehicles by at least 15 to 25%. So how does this work? Every truck has a gross vehicle weight, which is the weight of the vehicle itself plus the total loading capacity. Now, for example, if you have a truck with 2 axles, then the present GVW or gross vehicle weight is 16.2 tons. This will go up to 19 tons, and the percentage increase in loading capacity would be 25.4%. Similarly, if you have a 3-axle truck, the present GVW is 25 tons. This would go up to 28.5 tons, and the percentage increase in loading capacity would be 20.6%. So the government feels this will give a big boost to the industry, to the logistics sector, and also the automobile sector, because there would be a rush to buy this new category of vehicles. But we have been getting mixed reactions from the industry. While the Society for Indian Automobile Manufacturers have welcomed this move by the government, they have also said that the practice of overloading needs to be checked and eliminated completely. The All India Transporters Welfare Association expressed a word of caution as far as the heavy penalties are concerned, because we're told by our sources in the government that any overloading now or a violation of these new norms would entail very heavy penalties, and penalties to the tune of 10 times the present value. And to add to that, penalties under the Motor Vehicles Act as well. So the All India Transporters Welfare Association saying that penalties are not going to solve this practice of overloading, and you will have to have better roads as well. Otherwise, the rate of accidents will keep going up. We are told that this new norm will apply prospectively, and there is a certain degree of uncertainty within the industry as well as to what will happen with older vehicles.
Okay, all right, Parikshit, thanks very much for that. In fact, we also spoke to Ashok Leyland's MD and CEO, Vinod Dasari, on what this could mean for the industry. Let's listen in to what he had to say.
It is rather confusing at this point, because somebody who has bought a vehicle, let's say, for 25 ton, that vehicle has been designed for a GVW of 25 tons, the braking has been designed for 25 tons. If the argument that the government has that they are overloading that much anyway today, well, if they are overloading that much anyway today, then there should be no impact on vehicle volumes, because tomorrow they will say, okay, now you carry 28 tons, and that would be all that you're allowed to carry, and it will be very strictly imposed. I find it a bit surprising on two reasons. One, somebody who's bought a vehicle today and somebody is going to buy a vehicle, let's say, after Tuesday, what does somebody who bought a vehicle do? I mean, he has a vehicle for 25 tons. He cannot suddenly get it registered for 28 tons because the brakes and everything have been designed for 25 tons. Even in US, one-axle truck or two-axle trucks have got the difference between India and US is 16 to 18 tons. Here we are going to 19 tons, which is the world's highest. Similarly, on three-axle trucks, we are going from 25 to 28. Once again, US is only at 26, which is the highest in the world. So we are going much higher than the world. And I am not sure our roads can take something like that.
Well, the big story from the telecom sector, the telecom regulator TRAI has called for stronger data protection framework in order to safeguard telecom consumers' privacy. Now, TRAI will be releasing a series of recommendations in order to improve the data privacy and security. They held that the consumers are owners of their data and the entities controlling processing their information are mere custodians. Ashmit Kumar joins us with more details on that. Ashmit.
So after nearly a culmination of one-year-long exercise, the TRAI has come out and made public its recommendations on data privacy, ownership, etc. What's critical here is that these are merely recommendations at this stage, not binding on the government, but still carry with them a substantial amount of weight. Let's first look at the recommendations. The recommendations now come under 4 subheads. The first one is personal data. Here, TRAI suggests that as far as ownership is concerned, it is each user and customer who is the actual owner here, not the entities collecting data. The entities are merely custodians who have the fiduciary duty with them to keep that data secure, but again, they are merely custodians. It also goes on to suggest that as far as these digital entities are concerned, they should not be using metadata to identify individual users. That's one key word of warning coming in from TRAI. Let's now look at the second leg, recommendations as far as data protection are concerned. Here, this is an interesting statement here. It's an interesting indictment of the current scenario. TRAI suggests that the existing framework is just not sufficient, that there is need for a legislative framework to, again, address the needs of data privacy. But in the interim, it suggests that the license conditions as far as telcos are concerned can be extended to all digital entities, which includes browsers, apps, operating systems. So that's something that TRAI has suggested as an interim measure. It also suggests that there should be a framework, a regulatory framework for, again, regulating these digital entities by way of browsers and application. It also goes on to say that the concept of data minimization should be promoted. It essentially means that an entity should not collect any more data than it absolutely is required for making available a service to the customer. Let's move ahead now as far as recommendations on user empowerment is concerned. Here, essentially, what TRAI is suggesting is that the right to choice, the right to notice, the right to consent, the right to data portability, as well as the right to forget should rest with the customer. That should be a right that should be made available to the customers. It also goes on to suggest that the terms and conditions that we have in terms of the consent agreements that various applications have, that should be multilingual, should be easy to understand and unbiased. These are 3 preconditions that TRAI has laid down. And finally, recommendations as far as data privacy are concerned. Here, what TRAI is suggesting is essentially that personal data of consumers should be encrypted at all times, at points of collection, at points of storage, and that they should only be decrypted by authorized entities. So that's one key suggestion here. And finally, it goes on to say that as far as entities are concerned, digital entities, they should disclose details of potential vulnerabilities as well as breaches. So this is the broad sum and substance of the recommendations that the TRAI has put forth. Keep in mind that, of course, the big recommendations that the stakeholders are watching out for would be recommendations coming in from the Shri Krishna Committee. Back to you.